The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning. Hopefully you can go and hear me now. A few tech gremlins that are coming through, so please apologise on our behalf, but hopefully we've got the problem rectified. The first time we're using some new systems today, so of course the gremlins come out when we go live on a proper event. As you can see on your screen here, hopefully you can see the risk warning that we can see now, and I want you to have a quick look at that before we get started today. Look, let's just get into it. Hopefully I can go and get this to go and work and make some information for you. And I do apologize yet again. So hopefully on your screen right now, you can see what's called the Citigroup Economic Surprise Index. Now, for those who are not aware of this particular indicator, what it looks at is aggregate economic data and how it comes out relative to economist forecasts. And at the moment, on the top screen here, you can see is US economic data in red. You can see Eurozone data in blue, and you can see Chinese economic data in yellow here. And I picked these because you've got the world's largest individual economy, you've got the world's largest economic bloc, and then you've got the world's second largest economy, and a still very fast growing one at that. And I just want to go and show what we've seen recently, because it's really, really interesting to see how all of a sudden the US data has started to turn. Now, this is not a leading indicator by any stretch of the imagination, but what it's doing is taking a whole bunch of economic data and then saying, well, here's how it's coming out now relative to expectations. A score above 0, and the US score is 7.4, indicates that more data than not is beating expectations. Anything below 0, and then we can go and put Eurozone data in the list there, it's at negative 36.1, and Chinese data minus 39.5. Anything below 0 indicates a majority of economic data is coming underneath expectations. And it's really interesting to see what's happened here, because we've been talking so much about the need for the Fed to get aggressive to go and prevent the likelihood of a hard landing and such. And then all we've seen over the past month and a bit is that the data has started to turn quite rapidly. And that's actually corresponded with a big loosening in US financial conditions. So whilst the Federal Reserve has only cut by 50 basis points, what we have priced into the market is from relative to where they were, we've got more than 250 basis points worth of cuts that were priced in. And that's flowed through to stock valuations, volatility across markets, credit spreads, bond yields, US dollar, and the like. And it's all become a much more, what's the right word, an environment which is much more palatable to go and help foster growth in the US economy. And it's just interesting to go and see how it's turned really aggressively, where you can see here, Eurozone data is still mired in negative territory, and the Chinese data, as we know, there are steps being taken to go and try and address that, but it's been disappointing for a long, long period of time. Now, when you go and look at what that means when it comes to some of the other factors, well, markets are starting to go and pay attention to what's going on here, because this next chart, you can get up on the screen, is what's called US inflation breakevens. So we've got clear evidence coming through that economic data is starting to go and turn again. That US economic exceptionalism story is starting to go and potentially take foot again. And this is basically looking at the average inflation rate, annual inflation rate expected over the next decade. And that's basically determined by market pricing. And what you can see here is that whilst it's not a big increase, we saw that it got down towards 2%, which of course is the Fed's mandate. And then what we're seeing is a big pickup, around about 20 or so basis points from those levels, around about 2.2%. Now that's well above the levels that we saw back before the pandemic, where the Fed was struggling to go and achieve its inflation mandate. But what we're seeing is economic data starting to impress, and the inflationary backdrop, the expectations for what that means, that stronger economic growth potentially coming through, is now starting to go and filter through when it comes to movements in inflation expectations. And it's not just that which is the markets are taking notice of, because you can see that when it comes to Fed pricing, looking here on your screen, this is looking at Fed funds futures, and on the left-hand pane here is market expectations for the degree of rate cuts over the final two meetings from the Fed in 2024. And then on the right-hand pane is market pricing looking out until the end of 2025 for rate cuts. And whilst there's still a lot priced in, Fed funds futures is pricing still about 78 basis points worth of cuts. It's a little bit less when you look at OIS pricing. It's still around about 68, 69 in that particular market. A lot of easing still priced in, but you can see it's been moving off the lows. Around about 10 basis points has been stripped out of the 2024 curve. And then when you look at when it comes to longer term expectations out to the end of next year, well, you can see here, at one point there it was about 2.4, and now we're looking at 2.1. So there've been a more than a full 25 basis point cut already stripped out of market pricing. And that's telling you that no, the markets are starting to go and question again, like we did at the very start of this year, whether the degree of easing that's being priced in to Fed rate cuts over the next year is maybe a little bit too much relative to the incoming economic data. Of course, we saw markets have to go and pair expectations for nearly 7 rate cuts at the start of this year, and then eventually got down to around about 1 before starting to add them back on again. So it's clear the markets are a little bit concerned that maybe we've jumped the gun again and we've got too aggressive when it comes to expectations for rate cuts. Another really interesting thing is what's going on in the bond market. The bond market gives you lots of different signals as to what expectations are for growth and inflation moving forward, and potentially risk premium as well, that something could go quite haywire in the economy. And what you can see here is that it's not unusual to go and see this on the right-hand side here is the 2-cents curve. So basically where 10-year yields are minus 2-year yields in the United States. And what we're seeing now is a steepening of that curve. And that's not unusual at the start of an easing cycle. Usually you see front-end yields going and drop down as the Fed starts cutting rates. And then that helps to go and make that more positive, that curve. But what is interesting right now is that despite the Fed going 50, and despite so much still being priced into the market, this on the left-hand pane is looking at actual movements in yields. And what they're doing is they're starting to go and tick higher. You've got across here, 30 years, 20 years, 5 years, 2 years, and 1 year tenors. Every single one is now starting to go and flick higher. So this steepening is what's called a bear steepening of the curve, the 2-cents curve. So what does that mean in practicality? Well, it means that markets are starting to go and price in the prospect of firmer growth and potentially higher inflation down the line. And if you talk about the landing scenarios that we see a lot in the media and the like, where we talk about a hard landing or a soft landing or a no landing, I'm not going to go and say that it's a no landing just yet. But the fact that we're seeing this bear steepening take place, not a bull steepening, which you'd normally go and see into an economic downturn, I think the markets are starting to go and get a little bit interested potentially that maybe the Fed won't have to go and cut anywhere near as aggressively as they do, because potentially that could go and lead to a re-acceleration in growth and inflation and mean that they're back at square one again, trying to go and tame inflation, like we saw so many times back in the 1970s and 1980s, trying to go and get on top of inflationary pressures. It's not just rates markets that are going and paying attention to what's going on right now. I want to have a quick look here at US dollar index, because it's playing very, very interesting games right now ahead of this key payrolls report later on today. You can see here, very long running downtrend, been tested a few times. And then yesterday, boom, straight through it. Another downtrend, straight through that. And importantly, it's gone through the 50-day moving average. So higher yields, better US economic data, and that's flowing through to what's going on in the currency markets as well. So you can see the US dollar index has broken above this 50-day moving average and is now holding above it. So potentially from a trading perspective, you can see that against maybe the euro, the yen, the two biggest components of the DXY, potentially we could go and see a lot more selling in those names and then buying the dollar in response. So the dollar is breaking out, and so too are rates markets, because let's have a quick look at what's going on with US 2-year Treasury note futures, which are amongst the most liquid futures contracts in the world. So you can go and look at this, and you can go and take the price signals as you would do any other market. And it's really interesting, the story that they're telling right now. So bit like the DXY, it was in trending, but you see it was moving higher. So as the price went up, yields came down. But what we're seeing is that panic at the start of August. We saw the big yen carry trade unwind. The price came up and tested this level on multiple occasions and couldn't get through in any meaningful degree. And what we've seen since then is it's now started to go and roll over. And then it's actually gone and broken through this uptrend. And it's now looking at this level here, 103.33 on the charts and this 50-day moving average. This is a very important level because if we start to go and see this broken to the downside, it points to the likelihood of a far larger increase in US yields coming through. Now, if that takes place, think about all the things that have been rallying really hard on the back of expectations that we see lower yields and a softer US dollar. Commodities, emerging markets, riskier asset classes potentially could be at risk. I'd also go and throw some of the other cyclical stocks in there as well. So this right now, this break, this is pretty meaningful, but I think if we would go through here and remember I've got payrolls later on today, would be quite interesting to go and see what happens, because if it goes for lower, we're talking about much higher yields in the United States. Just looking from a momentum perspective as well, we saw that there was a divergence between price and RSI, so that it was warning that potentially the bullish momentum in US 2-year Treasury notes was starting to go and wane, and that's now starting to go and play to fruition. The signal as well is being confirmed by MACD. Let's get to the main event, because tonight it's going to be a big one. Non-farm payrolls, every single time, it's a very, very big event. But in particular tonight, it's going to be especially so, because we know that the Fed has got a limited amount of data points that they can go off. And we know there's a big emphasis on the labor market as well. And we've seen all this other economic data, the ISM services number that came out last night, beat expectations handsomely. We saw things like ADP employment and other areas as well, looking very, very strong. So we've got a lot riding on this particular release tonight. Now, just to go and get to, the right area here, you can see here. So what are we looking for? Well, the key things that you need to go and look at. The markets almost certainly will go and react initially off the payrolls number. So we're looking, markets expecting 140,000 from 142,000 previously. There's every likelihood, given the trend we've seen recently, that the prior data could be revised lower. It tends to be revised lower more often than not. When it comes to historic data as well, there is a tendency in the month of September to go and actually see undershoots relative to expectations. Whether that transpires tonight, we don't sure, but certainly that's something to keep an eye out as well. But to me, that's not the most important number. The payrolls number is a secondary consideration. What you want to go and be looking at is this one right here, the unemployment rate. That is what the Fed is graded on. That's what their full employment mandate is about. That's what you need to be paying very, very close attention to. It's expected to hold at 4.2%, unchanged from August. If we were to go and see that number go and push lower, 4.1%, that could go and really create some havoc in rates markets. I was talking about the prospect of higher yields. If we start to go and see some signs that maybe the unemployment rate's already peaked and maybe starting to go and roll over, that would be very, very damaging for the long rates case, and will point to high yields and probably some problems in riskier asset classes. So that's really important. Alternatively, of course, if we get, let's say, a 4.3% reading, well, a lot of this economic exceptionalism story may start to go and dissipate a little bit. It'll be pretty certain that markets will go and move fairly aggressively to go and price in a 50, in my opinion, if we see the unemployment rate go and print at 4.3% or higher. One thing that doesn't get enough attention, in my particular opinion, when it comes to this jobs report, is the underutilization rate, this underemployment rate, as it's described here, U6. So what does this include? Well, it includes unemployed workers. It includes people who are marginally attached to the workforce. So they've shown interest in working in the past year, but they're not currently looking for work right now. So they can go and join the workforce if things are starting to go and pick up. And it also includes workers who would like to work more hours, but due to economic reasons, they can't get enough to go and suffice their needs. So to me, when you talk about what's going on in the labor market and signs of loosening or becoming more tight again, that the U6, the underutilization rate, is the one that I'll be paying pretty close attention to as well. That's printed at 7.9% previously. if we're going to see that start to go and roll over as well, it implies that tightening conditions in the labour market, which could go and start to go and swing the conversation back away from unemployment to potentially wage pressures and inflation. So they're the three things that I'll be paying pretty close attention to in tonight's payrolls report. Let's go and have a look to the week ahead as well, because look, it's not going to be as big an event, and we're going to also have China back online as well. So that's going to be pretty important. Let's just go and have a quick look. In Australia, we've got a few things. I wouldn't classify the NAB business survey and Westpac consumer confidence as being market moving. This is coming from TradingView, this view. That's not going to go and really move the markets one way or another. RBA meeting minutes as well. Yeah, probably not. The Fed minutes, well, they cut 50, so it's going to get a lot of attention, but is it going to go and give us any more information? I'd say probably not. It'll be a bit stale considering we're going to get the payrolls report out tonight, including a speech from John Williams, the New York Fed president. That will be 30 minutes after payrolls as well. So I'll be paying close attention to what the Fed speakers have to go and say, Williams onwards over the next week. You can see here, US inflation is going to be back in focus as well. We see that coming through on Thursday, and then PPI on Friday as well. All the times you can see listed on your screen here are Australian Eastern Standard Time. One thing that's going to be interesting as well this week is that, or next week, sorry, is the RBNZ interest rate decision. Very small economy, granted, but a lot of people like to go and look at the Kiwi. Creates a lot of volatility. My view is that we'll see a 50 basis point cut down to a cash rate of 4.75%. They'll be out at midday on Wednesday, Australian Eastern Standard Time, 2 p.m. in Wellington. So there are the key things to go and have a quick look at next week. When you talk about the New Zealand rate decision in particular, you've got clear evidence that the economy is already starting to go and contract again. You've got business surveys suggesting that recessionary conditions remain pretty much entrenched, and inflationary pressures are clearly trending lower. And then you've also got the stronger US dollar taking some of the heat out of tradable inflation. So that's to me why a 50 is more likely than not. That's what the markets are now moved to go and price as well. And I wouldn't be surprised to go and see a follow-up 50 as well coming through in November. Let's get to some of the talking points in markets. Shall we start having a look at crude? Because that's been really, really important over the past couple of days, a huge rebound that's come through. Of course, Middle East tensions, very difficult for markets to go and price, but one thing that does go and move off that pretty aggressively is crude oil futures. And you can see here, we'll start from the bottom. When it comes to signals from momentum, you see MACD is trending higher. You can see that's also been confirmed by RSI 14. And when you look at the price action, well, it's been undeniably bullish at this point in time. So bounced off this 67.30 level where the price had been testing multiple times, went quite a long way below it, and then all of a sudden like a launch pad up, and then $70 you can see has been another minor area that's done some work. It bounced off that, and then through the 50-day moving average, and then another resistance level at 72.34, and then it's also gone and taken out this former uptrend that now is acting as an uptrend resistance as well, and through the 200-day moving average. So it's gone and obliterated a lot of important levels, and on the back of some pretty decent volumes as well coming through. So there's a lot of volumes to accompany the move, which tells me that in likelihood, momentum's looking bullish, the price action's looking bullish. It's done away with some pretty key levels at the moment. We're looking at right now, of course, we could go and see some kind of right tail risk and a peaceful resolution in the Middle East that could go and see a lot of it unwind. But right now, if you're looking to go and trade crude, potentially one setup would be to go and look to go and buy dips towards the 200-day moving average with a stop beneath this uptrend here for protection about its reversal. On the top side, 76.42 is the first level, and then you can see here a long-running downtrend is currently located about 77.30 or so, and then above that 77.81 would be another level to keep an eye on, which was the peak that we saw back in August this year. I want to have a look at SPY futures. I've seen a couple of media headlines out today raising the question, why is it such a heavy market? Well, I think technicals can probably explain a lot of it. So you can see here, I did write a piece on TradingView about this earlier in the week about how it was a pretty important session coming up. Didn't happen during that session, it happened yesterday, but you can see here, uptrend, and then all of a sudden was testing it, broke through, and you can see 8243 was the level that the price was doing some work and bouncing off as well. And then that's given way. And you can see right now a big flush. Next level on the downside, 8137 is what to keep an eye on. Below that, the 50-day moving average has been very, very influential and has been a great place in the past, the recent past, to go and initiate longs. But when you look at what's going on when it comes to RSI 14, well, it was diverging between prices. That was a warning that was already in place. And now MACD, they're going to zoom in a little bit. You can see it's confirmed the bearish signal on price. So when you ask what's going on with the with SPY futures today in Australia, well, I can tell you, it broke an uptrend. That to me is much more important. You've also got to put into the equation risk events, not only the other non-farm payrolls report out later this evening, but of course, what could potentially happen over the weekend. And given where it sits on the charts, it's going to be very difficult for the price to go and rally towards the close. Profit taking is probably going to be the way. So keep a close eye. 8137 is the level that I'll be paying pretty close attention to. Let's have a quick look at what's going on when it comes to some of the precious metal space, because that's a pretty interesting one as well at the moment. I did a note on this yesterday, and a lot of attention costs gets put in place when it comes to gold and silver, gold in particular, as a safe haven. Well, I can tell you right now, it's not really behaving as a safe haven. It's behaving more as a play on the global reflation, a pickup in economic growth and inflationary pressures. From a technical perspective, you can see here, the price looks to be calling what appears to be a pretty obvious bull pennant. And it's been testing both sides at the moment. And one thing that comes to mind here, we've seen both trending low when it comes to RSI 14 and MACD. So that's potentially giving us some negative signals, but from a price perspective, have a look at the other downside wicks here on the last 2 daily bars in gold. So there's clearly buyers around about 2640. So that's one to keep an eye on right now. Being in part of a pennant, if we do break higher, it could be quite a decent move considering how it's been coiling. If we do break to the top side here, a look at the former record or the current record highs will be the obvious one. If we see a reversal back lower, 2625.80, and then on the downside, you've got 2600 where the price stalled back in the middle of September, and then you've also got an uptrend as well that the price has done a lot of work and bounced off on numerous occasions, and that is just below that particular level to keep an eye on. So at the moment, gold is looking good from a technical perspective. So too, silver, it's got to be said, looking at very much a similar kind of setup here as to what we're looking with gold. Again, some form of a bullish pennant that we're looking at this point, coiling up, and then the price action in the last few days, it's had a look at this downtrend, this uptrend, sorry, support, bounced off it a few times, and then right now it's testing that. If we go through this level here, we break this downtrend, then we're talking about 32.50 where the price was stuck below. That was the former 12-year high, and then above that, 32.50. Looking at what's going on, the downtrend in RSI 14, well, it's been broken. And then also we're seeing that maybe MACD is not going to go crossover. So the bearish bias that I held yesterday when I was talking about it potentially is changing a little bit right now. Really quickly, when it comes to gold and silver, rather than being the safe haven, just to reinforce, it's very, very much obvious at this point in time for me that it's much more a play on what's going on when it comes to the global economy and the reflationary outlook that's out there right now. You can tell that because what's happening, well, it's got a pretty decent inverse relationship with the shape of the Fed funds curve. So when we see that expectations for rate cuts grow, gold typically goes higher and vice versa. And then you've got the 2s-10s curve, the relationship over the past month here is very, very strong. So as it becomes more steep, indicating more growth, more inflation in the future, gold has typically moved in the same direction. And down here, 10-year inflation break-evens in the States, again, that average inflation rate expected over the next decade at 0.94. And it's the same deal with silver as well. So very, very strong correlation. So it's not really a safe haven. So depending what happens over the weekend, of course, and what happens potentially later today, if you're putting your eggs in one basket saying, well, this is an area to be if I know that something does get really, really gnarly out there, potentially won't be. And it also applies for payrolls as well. If the payrolls figures comes out pretty strong, potentially we could go and see gold and silver break out to the top side rather than to the downside. So keep a close eye on that as well. Beyond that, I just want to have a quick chat as well about Chinese market reopenings, because it's been really interesting to go and see what's been happening in that particular front. Indeed, I'll go and put up, this is the chart of CSI 300 futures. So they've been closed since Monday. You can see a big move here. It's across all the different no particular markets here. This jackknifing high, this is A50 futures, same again with Hang Seng, which is the only one that I've seen any real semblance of no respect for prior levels. You can see it's sold out at the highs that were struck back at the start of 2023. The bit of the profit taking we've seen recently, I think, is more reflective of maybe capital getting ready to go and be deployed back into Chinese markets when they reopen on Tuesday. That's my gut feel. And whilst we haven't got any specific details about the fiscal stimulus at this point in time, I don't think it's going to go and stop markets from getting pretty excited about it. If you look over past periods of time, past cycles where we saw lots and lots of excitement and retail-driven frenzies in Chinese stocks, we saw big moves, and I'm talking about multitudes of 100% plus moves, and we haven't seen anything near that like at this particular point just yet. And so markets can get disappointed really quickly if we don't see anything concrete, or maybe if this fiscal stimulus that got the markets really excited last Thursday doesn't come to fruition. But realistically, for the time being, unless we don't get any information whatsoever, just the hope that's out there, the potential we could go and see a lot of stimulus money coming into the economy and the like should be enough to go and keep them really supported next week. Just to go and finish off on that point, some of the things that I'm watching, and you do have to put the disclaimer that we do not have full participation in the marketplace because Chinese markets and Chinese traders and investors, a lot of them are currently on holidays. Other markets, Dr. Copper, iron ore, the Chinese yuan, a lot of them are not confirming the bullish signals coming through from the stocks. We'll see whether that goes and reasserts itself next week, whether they start to go and move in the same direction. But right now, that's giving one little red flag. So still looks like the upside, but if we don't get any information, there's clearly some risks out there that we might go and unwind some of the moves. At this point, I'll go and open the floor. Reminder, anyone who wants to go and ask any questions, you're doing so at your own free will. The views are mine, and they are only general advice in nature. I'm not going to go and consider any of your personal circumstances. I'll give you a moment just to go and get into that, and then I'll come back to you. Unless something comes through in the last 20 seconds or so, let's go and call it quits. Thank you so much for your time today. Hopefully you found the information worthwhile. Any questions, get in contact with your representative. And of course, you can find me on Twitter at Scutty. Happy to go and help out where I can. Everyone have a fantastic weekend. Good luck trading out there, and I'll catch you next week.